Good day, ladies and gentlemen. Welcome to my practical financial accounting tutorial. Today I'll be dealing with journal entry. This is Dunzo Onwordi. We deal with our tutorial here, applying the case study. My email is on the screen. If you need to communicate to me regarding this lesson at the end of it, please do so, quoting reference PFA 1000103. Today's journal entry. What do we mean by journal entry? This is a document that shows all the accounts that is relevant to a particular transaction, showing which is to be debited and which is to be credited. A journal entry will contain at least 2 accounts. But in certain circumstances, for instance, where there's a VAT implication in a particular transaction, it will contain the VAT account, making it more than 2 accounts to deal with. Simply, a journal entry is a record of all business transactions in the accounting books of a business entity. All right. I've already described it. It will contain a debit and a corresponding credit, and every credit will also have a corresponding debit. A properly documented journal entry will consist of the correct date, as the date of the event, the amount involved, a fair description of the transaction, very short and precise description of what has happened, and a unique reference number or folio. Journal entry will assist the company in keeping their records for management sake purposes. When properly done, it will help to produce accounts like populate the company business accounts, like the sales ledger, purchase ledger, other nominals like rent, rate, light and heat, printing, postage and stationery, and so on. So a properly documented journal entry will help to produce all these accounts. Once these accounts are produced, compiled, a list can be derived from the balances of this account, and this list is termed the trial balance. It is from this trial balance that further statement like the income statement, which is profit and loss account, statement of financial position, which is balance sheet, cash flow statement, it's from this trial balance that all those things will now be produced. Though we are dealing with journal entry, but since we are here with the trial balance now, it's good to know that the trial balance usually balance so long as every entry have an equal and opposite side to it. So if you debit 100, there must be a credit of 100. It could be in 2 bits, like maybe debit 100, credit 50, another credit 50, but both end side of the account must balance. In a very unusual case where this trial balance do not balance due to some error, an account termed suspect account will be inserted temporarily to close off the trial balance. After further investigation, if the errors are found, they will be reversed out and the suspect account will come back to 0. This trial balance, though we're still talking about trial balance, since I'm here already, I got to do that, though our main idea today is journal entry, but it's the offshoot from journal entry. Trial balance has got its limitation. It will not tell if there's an error. For example, if the wrong account was chosen, given, say, debiting the furniture account rather than the equipment account, the trial balance will not tell you that there's an error. But the individual account involved, these 2 accounts, will be wrong. Another limitation is if there's mixed up in the debit and credit for one account, the trial balance will not detect this error. You won't find it in trial balance. As an example again, if the supplier is paid £50, and then if you remember my advice to debit the receiver and credit the giver. So if you go and debit the giver, that's wrong, which is done here. Cash was debited. And if you go and credit the receiver, that's wrong again. You have to credit the receiver, the giver, and debit the receiver. Okay? Account payable is receiving, you should debit the account payable, not credit it. So that's wrong. This error will not be detected because entry has, debit and credit have gone through the trial balance or the account. It doesn't matter where they are going to, but so long as they have gone through opposite sides, the trial balance will balance. It is the individual account that will be wrong. There are other types of error that can be found in trial balance. There are 9 of them here. The first 6 will not need you to open up a suspect account, but the last 3 will need suspect account to be opened. The first one there is error of omission, where a transaction is not recorded at all. You didn't pick it from the source document, and then it's not in the journal entry. So trial balance will not detect this error. So that will not need us to open a suspect account. No suspect account. The second error is error of omission. Error of principle. Error of principle here, I mean, if you miss out the basic principle of what you are dealing with. For instance, if you repair an asset, okay, and then you debit the asset account instead of the expense account, that's a repair account in the income statement, that the principle is wrong. All right, you can't debit an asset when it is not increasing the value of the asset. When you repair an asset, you're merely bringing it back to its original condition. So you should write it off the period the expense, the cost was incurred. So that is the error of principle. Number 4 is error of original entry. Maybe the original entry is wrong from source. You pick the wrong figure from the source document. Instead of 1,000, you just put 100 in the journal entry. The trial balance will not notice this, and then you will not need to create a sources account. Reversal, a complete reversal of entry is another error that will not need a sources account. A compensating error will not need a sources account. When you're compensating, so nothing will be found. If you debit more and credit more, so what's the point? You won't find it. Or you debit less and you credit less than the actual amount. The TB will not detect this. So, but individual accounts will be wrong, but the trial balance will balance. Addition error is the one that we need a source account. Addition error. It's like when you issue checks, like maybe loads of checks, say 50 checks to individual staffs, okay, and these checks we posted individually into the cash account, all right, which is like creating a cash account for giving the fund. But the total, to make it quicker, posting quicker, easier, you add it, you batch up all the checks, and then you either undercast the total or overcast the total. Then you post this total, this wrong total, into the debit side in the income statement as maybe wage and salary. So you can see straight away that the item in the income statement, the debit is wrong, different from the individual credits to the cash account. So this will need us to open the sources account, and when the errors are found, they will be reversed out. Okay, that's the error of addition. The other error is a posting error, trial balance error. Trial balance error could be maybe when you kind of put in the extract the balance into the trial balance, you may make a mistake, put the wrong figure into the trial balance, maybe 10,500, you just post 10,000 only into the maybe debit or credit side of the trial balance. This is trial balance error. Or you completely omit an item from the extraction, that maybe the ledger's account, you didn't extract one of the balances, and it's like not in the trial balance. For instance, if you didn't bring in the sale to sorry, you cannot omit the sale. You will notice you missed out the sale. Those are the things you are targeting: the sales, the purchases, the cost of goods sold, the inventory. Those are the crucial item every staff look out for. So if it's something like maybe miscellaneous account, like insurance claim, motor expenses, or fine, all those petty small items, you might just not remember and notice them, and then you did not extract them into the trial balance. So the first thing is, if you have a difference in your trial balance, I'll quickly check my list, that's my extraction, and see if there's any similar figure in the balances to my error difference in my trial balance. If that's the case, I will quickly check the name of the account and see if it's in my trial balance list. If it's not there, that is the error. Okay. Right. Case study 8, JJC Limited, a VAT registered company. It's an example to kind of portray this tutorial. We are here to prepare the journal entry for the following transactions relating to JJC Limited for 5 months to 31st May 2020. Note the VAT implications, and the standard rate, VAT rate is 20%. All right. So this is here is the kind of format for journal entry. Let me quickly let's head it so we know how they look like. So in typical journal entry, you have the folio, the date, the account and description, debit or credit. So that's the way you lay out your journal entry. Let me quickly do this for one question here for want of time. Number 1, which is folio 1, bank payments for rent to Porsche Office Limited by transfer, that is the mode of payment, not check, is 5,400, including, this means including INCL, including VAT and standard rates on 1st of January 2020. So including means it's gross. This is a gross amount, okay? Watch out for how they are given. If they didn't say anything, it means it's net. But if they tell you it's gross, it means it's including VAT means gross. Or if they say it's gross, you know it's gross. And if they say it's X, it means that it's net again, so no VAT there. And if nothing is said, you take it as net. Right. Let's look at the first one. The first one are this gross amount to rent. If you VAT register, you don't post gross amount, you post the net amount, and then charge the other part of it to the VAT account. So what's the net here? This 5,400 is, let me work it out here, is 120%. That is, this is, the net is 100 plus 20, make it 120%. So if I do the equals 5,400, and then I will multiply it by, divide it by 120, and multiply it by 100. Multiply it by 100, okay? 100. That will give me 4,500 net. So if I post the first column, I always start from debit. So that's the 4,500 debit to rent account, and that's the date. All right. So the next thing is to, because I need the other debits relating to this transaction will be that of VAT control account. So the VAT is 20%. So 10% of, I will use this again, equals 20% of the net. That's net times 0.2, that's 20%, gave me 900. So my VAT charge will be 900. That VAT control account is debited 900. So, as I said, in journal entry, every debit must have a corresponding credit. So these two items here is all the debit I need to post here. And if you look at my Excel sum here, it is 5,400. The total of these two is 5,400, which is the gross amount given here. All right. So I will now go and then say post the gross amount, which is 5,400, to my bank account. Okay. That is how the debit has equaled the credit. Now you have to now do the final description and summarize very short. I say it's transfer. That's the mode of payment. Being payment to Porsche Office Limited for rent. That closes off the first folio 1 journal entry. And next time I will continue to point 10 here, and I will let you do point 5 item 11 to 15 as homework. All right. Okay. if you are happy, all right, I will quickly let you know that we run revision classes for professional exams, you know, here for ACCA, for CIMA, Chartered Institute of Management Accountant, and CIOT, Chartered Institute of Taxation, and then AAT. If you need to join my online class, please contact me and calling telephone number +44 798 426 5117 or email me on the email below there and specifying what you need. Okay, right. If you've enjoyed what you've seen today or listened to, please give me a thumbs up. All right, and then if this is your first time of joining me, do subscribe, please. This is how you can encourage us to keep posting material for your consumption. And then do not forget to press the notification bell so that you'll be the first to be alerted once my new lessons are uploaded. Until then, keep safe, and then goodbye.